Patanjali Keswani, who's the chairman and MD, now joining in to talk about the future of the company. And congratulations. Now, the share of online travel agents has increased the company's overall revenue contribution from 9% in FY15 to 20% in FY17. I want to understand, sir, is this going to continue?
Well, our total online bookings as a percentage of the total is 27%, of which 20% is by online travel agents and 7% is through our own brand website, lemontreehotels.com. You're right, it has increased significantly in the last few years, and going forward, I hope that it follows the trend that is seen in the rest of the world, especially the developed West. I believe in the United States it is over 50%, and I expect in India, with increasing internet penetration, improvement in increases in disposable income, this will continue to rise. So I see that as a very positive trend.
Hi, Mr. Keswani. Good to hear that. Let's also talk about the financials. Now, your net profit margins have improved from just about negative 10% in FY13 to negative 2% in FY17. But tell us if you will see a sustained improvement in your profits.
Well, I think there is a lack of clarity on how profits move in our industry. So let me explain a little further. In the last 5 years, we have increased our owned hotel supply by close to 100%. What does this mean? Last 5 years have been very traumatic for the hotel industry because after the global financial crisis, there was a sustained period of supply injection in India in the hotel sector. Demand growth was therefore much less than the rate of growth of supply. As a result, year on year, the pricing of hotels in India was remaining flat or even reducing sometimes. In that same period, we doubled the number of hotels we own. We mitigated risk by ensuring our debt equity was 0.5:1, but nonetheless, we opened so many hotels in the last 5 years that we were not able to stabilize them quickly, so they took 2 to 3 years, during which...
Okay, now your margins have been improving as the OPEX growth has lagged your revenue growth. So do you think that this kind of a margin run rate will be sustainable? What is the trajectory that you're penciling in?
As I said, when you open so many hotels, what happens is that very often your revenue is not significantly ahead of your expenses. So your operating profit margins are lower till you stabilize hotels. Because keep in mind, our business and the hotel business, when you own assets, it is a long gestation, capital intensive business. So if you look at our operating margins, I think 2 years ago they were about 27%. Now what is this operating margin? This is the one I'm talking about, is net operating margin. So if you take all our hotels, as I said, we have about 48 operating hotels right now. We own 32 of them, own and lease 32 of them. If you aggregate all their EBITDAs at the hotel level, you have gross operating profit or EBITDA at the gross level. From that, you deduct corporate expenses and you deduct lease rentals to get to net operating margins. Now, if you look at the last 3 to 4 years, our corporate expenses have been, because we had not opened so many hotels, our revenues were still muted. We were not able to distribute our corporate expenses over a large revenue base. But if you look at the last 2 years, our operating profit margins after corporate expenses increased, I think, from 17-18% to 29% in FY17. In FY18, in the first 9 months, it increased to 33%, which means that at the gross level, when we do roughly 45-46% operating profit margin, if on a larger inventory base, a larger revenue base, we deducted about 12% for our corporate expenses and lease rentals and came to a net operating margin of 33. Now, if you just look at the fact that in the next 3-4 years, we are practically doubling the number of hotels that we have, and that is, that has been stated in our RHP and prospectus. We are expecting prices to improve. Therefore, on that vastly expanded revenue base, we expect that corporate expenses as a percentage of sales will reduce dramatically. So obviously, net operating profit margin should then improve significantly.
Okay. You have a very low F&B revenue share, about just 21% of revenues versus what your peers have, almost 40%. What could be the reason for this, for the low share? And I assume, F&B is a high margin business. So why the low share?
firstly, it is a low share of a low margin business. So again, there is an absence of understanding here. Let me give you a simple analogy. If I sell one room for 4 nights at say 6,000 rupees, I make more profit from that sale than if I sell a banquet party for 100 people. So that requires, as you can imagine, a lot more food, a lot more staff, you know. It is our business model. We are very clear. We want to maximize sale of rooms because it has the highest operating profit margins. And when we build assets and we own assets, the most important thing you have to do is sweat that asset, which is sell the rooms. So again, there is sadly not enough understanding of this in India. You know, let me give you another example. If there are 2 hotels, one is doing 60% occupancy and all its F&B is rocking and it's full, and there is another hotel next to it which is doing 65% occupancy and it's doing hardly any F&B. In 5 years, let me tell you, the second hotel can buy the first hotel.
All right. Thanks very much for putting things into perspective. We'll let you go on that note. Remember, Lemon Tree, it's one of the largest hotel chains in the mid-cap priced hotel sector. Made quite a decent debut today, listing at about 61.6 rupees on the stock exchange versus the issue price of 56 rupees.